screen? Yes?
Yes.
Great. So, as we know, in the year of 2022, the life of the smallholder farmer has been as unpredictable as the weather. Of course, in Pakistan, many farmers suffered the great flood that has happened because of an extended period of extensive rains. But that situation was actually not unique to Pakistan. We are seeing in the world over, especially in the global south, that climate events are increasing in intensity as well as frequency. And so the problem is that small farming communities, and especially the smallholder farmer segment, are sort of trapped in a cycle of suboptimal yields and underproductivity. So in Kenya, where we have worked the longest, we see that average yields in the maize crop is about 2 metric tons per hectare, which is about now I should have done the calculations for the or the conversions into mons and acres, but we can see on the same metrics, the yield measurements for maize in the USA, which is actually the first country to implement widespread agricultural insurance globally, has more than 5 times the yield productivity for the same crop. Also, when we're looking at agricultural credit and the credit gap, we see globally that there is a gap of about $170 billion of credit gap in terms of the agricultural credit that is deployed versus the actual demand. And we see that same gap also in Pakistan, where only 18% of all farmers are actually receiving commercial credit directly from credit facilities. And the most vulnerable and the smallest farmers are paying much higher to be able to access credit so that they can buy inputs, which makes their cost of production much higher. We also see that in the insurance sector, because of the increase in frequency and intensity of events, there is a lot of uncertainty in the margins in the business. This drives up insurance premiums beyond the affordability, where whether it is the government or farmers themselves procuring insurance, it just is very difficult to find the right product and price mix where it actually delivers value, but is actually also commercially viable. And so then, what ends up happening is that the agricultural sector is left behind, and where there is great potential for the agricultural sector to be able to contribute towards national GDP growth, that is not being the case. And so it's a very sad situation, which is not only unique to one country, but where we're seeing similar patterns in many of the countries where we operate. And so what we have been doing as Pula Advisors, we are a commercial company that is working with governments, with development agencies, as well as private sector participants to design agricultural insurance, which can also provide benefit for even the smallest farmer. So our flagship product is the Area Yield Index Insurance, which we are working in 22 countries globally, largely on the African subcontinent, but thankfully with the partnership of TPL Insurance as well as HBL and BOP, who are our current 2 clients, we have done a 1-year contract of CLIS related pilots, whereby we took a portfolio of large-scale farmers from both of the banks in 4 districts in Punjab, and where we put them on the AYI product alongside the CLIS product, and we saw really an apples-to-apples comparison of how the private sector AYI performs against the government CLIS as well as against the Punjab Fasal Bima scheme. And so the average Pula farmer is cultivating on less than 2 acres of land and is paying roughly 1,800 rupees per acre. This is our global average, whereby in the US, an average farmer is farming on 445 acres and is paying 15,000 US dollars in premiums. And so we see what is the growth potential, of this market just, from this one data point. Now, in terms of the area yield that we have started in Pakistan, as I mentioned, we have already done the pilot in 4 districts, and both of the banks have confirmed that they will be continuing the engagement with us as we are continuing our engagement with the state bank. And we are also working with various stakeholders in both the Punjab government as well as the Sindh provincial governments to have a AYI solution for the non-commercial borrower farmer. So the AYI product can currently cover 24 crops, and that includes all 5 of the major crop values or crops in Pakistan, as well as many others. And there are also a number of crops that are currently under development, under product development, and we are also in development phase of livestock insurance solutions that are also index-based. So I just want to start here with some satellite images, and as an insurtech company, we are using both remote sensing capabilities as well as digitalized field forces to basically execute on our work. The satellite images are not used for the crop yield calculations, but this is used for forecasting as well as for building proposals, as well as also defining sometimes where crop cuts should be done in cases where there are certain special circumstances. For instance, if there are enormous floods, such as what has happened in Sindh in this past summer, but also in places where we have already had live engagements like Nigeria, which have also experienced similar floods, where if the areas where the engagement is impossible to do the crop cuts, then we will also look at similar agroecological zones to be able to do alternate crop cuts. But the reason why I'm showing this image is because we used the current flood estimations for the satellite imagery that we have on the select locations or districts within Sindh where typically there is a higher productivity or higher wheat production, and we are forecasting how much wheat production or wheat is actually going to be able to go into production for the upcoming season, so that we can build the insurance engagement around that. And so this has been shared not only with the Sindh government, but also with the Punjab government. Now, in terms of the execution of the area yield, unlike the Punjab Fasal Bima, where it is the government CRS that is executing on the crop cuts, Pula sets up our own teams, and we do our own execution. This is how we maintain the integrity of not only the data collection, but also the data management and sort of the data analysis as well. And so in Africa, we are the largest holder of yield data, farm-based yield data across the African continent. And we're able to do many different things, with that data. Including creating better insurance, that is actually sustainable and scalable in Africa as well as outside of Africa. So just to walk you through the process here, at the beginning of season, we do we do a box placement, which is basically tagging a certain area within the farm, which is actually going to be harvested by the field enumerator, the Pula staff who is actually going to do the yield measurement. We geotag the farms so that we can also couple the on-farm data against the satellite data. So we overlay the field data points on top of the satellite monitoring that we do. And then we also have a lot of pictorial evidence of the entire process. So the farmer standing next to the digital scale, the enumerator, so that if there's ever any contention or any misunderstanding or of whether or not a crop cut actually happened, then we not only have the data points to prove it, but we also have the pictures to prove it. And then these pictures are also used in our data cleaning. So if there is any, let's say, human manipulation of data or duplication of data, we have machine learning tools that are looking for the duplicate images, which will disqualify data, or if there's any tampering of any of the initial box, then that data point is also disqualified. So for each crop that we are covering, there are specific protocols for the CCEs, which are already endorsed by all of the global reinsurers that we are working with. And we are working with roughly about 24, 25 of the world's largest agricultural reinsurers. And as we may all know, there aren't that many that are participating in the agricultural space. And so really all the major players are already working with us. Swiss Re, as well as the African Risk Capacity, are also equity partners of Pula Advisors, but we work with all the major reinsurers, and for each engagement, we are basically bringing together. We put the engagement into our database of reinsurers, and then basically it's a market-based approach where the reinsurers can take the insurance, the risk that they wish to stomach. So just to give a comparison between the crop loan insurance scheme, or CLIS, versus what we are currently doing, as we all know, there are a number of features on CLIS which is overdue for an upgrade. The first is that the payout ceiling is limited to only 3 times the premiums paid, and even the premium rate of the current CLIS product is not an actuarially based product. So the premium rate, is already too low. And then of course the payout is also very low. Now the payout trigger is also problematic because it is neither objective. It is not an objective trigger. So because the trigger is done as a declaration of calamity by the government, and there are many considerations for that declaration. What we have seen is that for events, for natural calamity events like flood or drought or excessive rain, the government is more likely to declare a trigger, but those triggers are usually also not so objective. So regardless of whether it was a cotton farmer or a sugarcane farmer in a certain district that received excessive rains, they would receive the same level of payout regardless of the amount of loss that is experienced by each farmer. And so this has made this has made farming more and more risky for the cotton farmers, which is why we're also seeing that farmers are exiting that value chain, which is detrimental to the economy as a whole. And so by having a more scientific product that is triggered based on the actual yield losses, we can actually design a product that has more objective triggers with the events that are linked to the amount of loss, which to the farmers and to the government is more benefit, but also to the insurers is also a more calculated payout, because the payout is more directly linked to the actual loss that was experienced. And so with a better product, what we have seen is that, it has been much more scalable. So in terms of the structure of the engagement, Pula Advisors is never selling insurance directly to the farmers. And so this micro distribution model in the world around has pretty much failed to be scalable in the absence of a government mandate that farmers have to buy insurance. And so part of our secret to success for doing more than 6 million farmers in the last 6 years in Africa is by embedding insurance onto existing infrastructures and existing government programs, and such as the crop loan insurance scheme, which is already a existing program in Pakistan. So in terms of the farmer or the customer acquisition, that is done by the banks through their lending or their agricultural lending portfolios. And then what has changed between the current CLIS model and the AYI model is that rather than having individual farmers insured under individual policies, the insurance policies at a group level held by each bank on behalf of its farmers. The insurer to lender relationship otherwise is the same, and Pula has invited in this engagement SCORE, which is one of the largest reinsurers globally, to take the majority of the risk placement, and the actual pricing, the product design, as well as the reinsurance placement was arranged by Pula, and we are also the calculation agent for the execution of the AYI. So Pula is not a risk taker in the in the engagements. The risk taking is always done typically with a 20-80 split between the local insurer and the global reinsurers. And so in terms of the other details of the first year pilot, the locations were chosen by the banks where they have concentration of large-scale farmers. And so roughly 250 large-scale farmers with a portfolio value of about 300 million rupees joined in the first season. And in the second season for rice, that portfolio was about doubled. The gross premium rate was capped at 3.7%, which was, and that premium budget was shared three-way between the farmer, the bank, as well as the insurer. And Pula also helped to do our part by removing our direct costs and thereby bringing the premium rate down from 5% in the total gross premium rate down to 3.7, which was without our direct cost involved. So in terms of the season results, because of the heat waves that were experienced last winter and especially last April, most farmers experienced yield loss between 20 and 30%. And in one of the 4 districts, we went just below the trigger of 70% at 68.8 0.54%. And so there was a small payout which was made to the farmers that were insured in Jayapura. We were able to do the payout ceremony within 1 month of the harvest end. Now, actually, just in the past week, as I am returning back from another week spent in Pakistan, both BOP and HBL have confirmed that they will be joining us for another season. Well, one more season for HBL and 2 more seasons for Bank of Punjab. So we saw that. So in terms of the proposals that we are making to the provincial governments in Punjab as well as in Sindh, the structure, the transaction structure is similar to the pilots that we have conducted with the banks, in that we are looking to work with an aggregator, which in this case would be the provincial governments, most likely the agriculture departments, holding a group insurance policy on behalf of the group of farmers that they wish to insure. And so what we are currently in discussion with the Punjab government is to take certain districts within the current Fasal Bima scheme and basically give it to Pula. And then we can see exactly how the execution is different from the CRS execution with a true apples to apples comparison, and this also enables us to have a larger scale of operation. And in area yield, scale is a very important component of maintaining a product that is affordable and is delivering value to all of the different stakeholders. And so even with a first season engagement, the proposal has been for a premium budget of 1 billion rupees for the upcoming Rabi season. And obviously that is much bigger than what any one insurance company can do itself. And so what has been proposed and accepted by the government is for there to be collectives, the insurance consortia to come together to basically do a public tender bid, and whereby the insurance consortia will be supported by Pula Advisors, who will be doing the product pricing and the structure, as well as the loss assessment, and also supporting on the reinsurance placement, with 80% of the insurance borne by the reinsurers for the engagement. So in the transaction structure, we are also splitting the premium funding source from the aggregator source, because in the other countries where we operate, where that is if the Department of Finance or the Ministry of Finance has to go through the agriculture, this is an additional opportunity for delays. And so from the get-go, we are structuring this as 2 separate parts of the structure to be able to hopefully prevent those kinds of delays in our engagement. And our similarly, outside of Punjab, we have a similar proposal with the government of Sindh, as well as the federal government with the BISP, the Benazir Income Support Program, and the Ministry of Poverty Alleviation, to be able to embed insurance on really any kind of financial structures that are already in place that has data on farmers. To have this group policy structure is more efficient in terms of the insurance delivery, since it saves on marketing costs from individual insurers or even the collective insurers to actually go and do that. And we're using the data that is already available and the infrastructures that are already available. And so that, you know, we can maximize on the value of the insurance to actually be in the actual product rather than on administration. So in terms of the agricultural insurance pool example, I just wanted to give the case study of Kenya, where Kenya only started agricultural insurance in 2016. And so that was started by the World Food Program in only 3 counties with a grand total of 900 farmers. And with that very humble beginning, currently, in 2022, there is about 1 million farmers across the 2 seasons that are receiving insurance against only a total population of roughly 3 million farmers in Kenya today. So the premium is typically split. 50% subsidy is given by the government of Kenya, and the area yield index starts with an 80% trigger. That is possible because we have been working in this country for over 5 years now, and reinsurers are willing to accept. Typically in new countries, we are starting with a 70-0-70 structure, or a 65, between a 60-0-60 structure and a 70-0-70 structure. And nowhere in the world can we start at a higher trigger than that, because the reinsurers are not willing to accept. And also because in first year of engagements, we have to start with government data. And as we all know, the government data points are not the most accurate or precise. And so until we ourselves are there to collect our own data, we cannot afford, we cannot actually provide higher structures for the area yield in new markets. Just this week, we are going to start a new engagement as well in Bangladesh, where for almost 6 months, you know, this has been the negotiation with the local stakeholders there, where, you know, they want the highest trigger, but eventually we were able to come to an agreement with our standard structure, which is the 70-0-70, and that will also be the case for all of the government discussions that we are having right now. It will be a 70-0-70 structure. And so in Kenya, the agricultural insurance pool or consortium is led by APA Insurance, which has been a longtime partner of Pula Advisors, and is working with 6 insurance companies to basically co-share in the local risk-taking of the agricultural insurance risk that is generated in Kenya through the AYI. So as we all know, crop insurance has been very much front and center also in the news. With TPL, we've done some media work as well, but most recently, Aminuddin Saab from TPL Insurance has been quoted in Dawn, you know, about this exact topic of how a more scientific approach is needed to upgrade the crop insurance product within Pakistan. And so these are some of the developments that are ongoing. So as I mentioned, we've completed the first season and now are in the final stages of completing the second season in our engagement with Bank of Punjab and HBL. And we have already submitted the conceptual proposals to both the Sindh government as well as the Punjab government. And we're having this discussion today because we need to put together the consortia for both of these engagements. Both HBL and BOP have confirmed renewals approvals for the upcoming Rabi season for this year. And there are many concurrent discussions that are also happening with development agencies who are also taking a great interest in the work that we are doing collectively. And we are also getting an interest in from the private sector, from large companies that are in the potato, cotton, wheat, and the sugarcane value chains. And so with that, this is pretty much the end of my end of my deck. I'd like to invite Mr. Hirji to make some a response, as well as an invitation and to the others for comments and questions. Thank you.
Okay, thank you, Ms. Elise Lee, for an excellent presentation. I'm not sure whether I can be heard. Can somebody respond, please?
Yes, we can.
Can you hear me?
Yeah, we're listening. Yes.
All right. Okay. I thank you very much for your presentation, and welcome this initiative. Maybe the time is just right for something like this to take us to the next level of crop insurance in Pakistan, an insurance that can benefit all the stakeholders, the farmers, the banks, the insurance companies, and also the government in this respect. And I would welcome all the insurance company members of IAP to come forward and participate in this program in whatever small or large manner that, for which they have a risk appetite. If you don't have much of a risk appetite, maybe you can take a very small share in this consortium, and, see what the results are. If they're satisfactory, then maybe next year you can take it to a higher level and increase your risk exposure accordingly. Is that an appropriate message, Elise?
Absolutely. So I think from the discussions that we are having, we want to get a sense of who is with us, who wants to basically come together for the building of the consortia. And we also understand, that the risk profile as well as the risk appetite is very different for Punjab versus Sindh. We all know that Sindh is much more risky, especially in the aftermath of, the current floods. And so, in terms of getting the actuarial pricing right, that is our core excellence. And so then that is where, Pula's first value proposition is to the risk takers, is that we will never give you a product which we are not 100% confident to be able to place with reinsurance capacity. And so then, with that confidence, we are inviting all of you to join us at whichever, capacity, is your appetite. And then, with that, of course, for each of the consortia that will come together, there will be a leader within the consortia, and we have to have an agreement within the members of the consortia who will be the leader. And then at the beginning there will be some sort of, I guess, startup challenges of how are we going to divvy up this pie, but I am very confident that with the vision of growing this business together and bringing this innovation to be able to be a basis to grow this market together, I believe that we will be able to come to that agreement quickly, and with confidence, because what we are doing in Pakistan, this is not our first rodeo, as we say. This has been tried and tested across the sub-Saharan African continent, and in a market like Pakistan, we have identified this as one of our priority markets because we are so confident, in the scalability of the solution, as well as the strength of institution, both on the insurance side, as well as, on the other side, with government.
Ms. Elise,
Yes.
just a quick comment, I'm sure each individual insurer would be looking for some information for them to be able to assess, say, what share they can take in this project. So, for example, say I would, as an individual insurer, say I'm ready to expose myself to a maximum probable loss of, say, 10 million Pak rupees. I would want to know that, to expose myself to not more than a possible loss of 10 million rupees, what percentage share should I take in this consortium? And would I get the same risk exposure as everyone else? So, for example, I would want the same share as a percentage distribution between Sindh and Punjab and different areas, so that everyone is exposed to the same level of risk. So, is there some way that you could help us to quantify this?
So the exact sort of quantification will only be possible once the government shares its requirements with us in terms of the locations as well as the distribution of the farmers. So that has not yet taken place in either of the provinces. In both of the provinces, the conceptual proposal has been accepted, and also we are working with the premium budget of 1 billion rupees, because that has been set as the min bar for this engagement. And so for area yield index insurance to actually deliver value, I mean, it has to have a certain scale. And so then what we are expecting is that for 1 billion premium value, we'll be able to insure roughly 100,000, maybe 150,000 farmers, but depending on the location and depending on the distribution, the premium rate can vary. So, in the wheat crop in Punjab, it's going to be a certain rate, but then for especially, in the areas where are traditionally more risky, it's going to be higher. And so it's now not knowing, those sort of input data points, I cannot really give you a firm number, against your number. And so give us a little bit of time to basically, have that discussion and further our discussions with the governments. And once we have those information, then we will produce the product note, which will say exactly, what is the TSI for the entire engagement and what is it going to be. And, within the consortia, there will be no cherry picking. So all of the consortia participants will take equal share in the at a portfolio.
Okay,
and I think that's
good to know.
Yes.
One more question is that is it only going to be going to involve those farmers who have taken loans from banks?
No.
Or is it going to include all farmers?
So ideally,
yeah.
Because for both of the engagements right now, the discussion on which farmers will be insured is continuously evolving. So at first we were only focusing on the credit linked or the larger farmers, and now we're moving more towards the smaller non-borrower farmers. So from our perspective, we don't care whether we are covering small farmers or large farmers, so long as we know who's paying the insurance. And in both cases, what we are proposing to the government is that the government pay 100% of the premium on behalf of its insured farmers. And so what is most likely going to be the case is going to be the farmers that are farming on 5 acres and below, so that the government can also justify, paying the 100% premium, which is, in all existing programs is the case for the smallest holder segment.
Okay, so what are the next steps then, Nabil? Maybe you can help us here. How should we proceed, and what should we be waiting for in order to be able to take this forward?
Somebody has raised his hand. So Nabil,
Umair Ismail sir.
Umair Ismail sir. Yes.
Hello, Elise. Elise, I just wanted to check for this particular project, you're only targeting Rabi season, or is it like Rabi and Kharif? The other thing is, while the districts, I believe, have not been finalized yet, are the crops being finalized?
So the crops we are focusing on are the 5 major crops. And so for Rabi season, it would obviously only be wheat. And then for the Kharif, it would be the other crops. And then the discussion with Punjab is currently 1 billion for Rabi only. And for Sindh, the initial proposal was made for 2 seasons. And so our current engagement with TPL and the 2 banks, the original contract was for 2 seasons, and it is always our preference to lock in 2 seasons at a time. But of course, we don't have a shelf product where, they have to do 2 seasons or they have to only do 1 season. I mean, we can customize this as per the requirements of the client. And in this case, the client is the government of Punjab or the government of Sindh. And so I hope that answers your question.
One more thing, particularly for the product design per se, when you will obviously, once things are more formal and you have better clarity with the Punjab government, what sort of product structuring that you're envisioning? Would you do separate concept notes for separate season, or you will just do a single note or a single, because the retentions or the participation, do you foresee that would vary on a season by season basis, or would the kind of consortia that you want to structure, you would want a single mandate coming in for both the seasons? Because
so if the contract will be on an annual basis, then the consortia will also follow the same structure. And so then, we don't want to be reorganizing the consortia season by season. We want to do it, for the entire engagement. And, the way that the consortia works in other countries is that, it's also not just, for a single year, but year on year, we're also growing the consortia. So, it starts with 2 or 3 insurers, and then year on year, the members of the consortia can choose to increase the pool. And so the mechanisms for, how the consortia operates, we have shared a template agreement form that is based on, one of the consortia that we are participating in Africa. And so, and that can be customized, for the engagement in Pakistan with the insurers that are going to participate. So you decide on the rules of the engagement. We'll tell you if, certain things don't make sense and is not really built for scale. And then, basically the participating members have to come to an agreement, that's what we will do.
Elise, one more question here is that can we have some idea about the loss ratios in Africa over the last 5 years? Have insurers made money? Have they lost money, or has it been a mixed review over time?
Yes, that's an excellent question. And actually, I'm a little bit kicking myself for removing that one slide. And so, Hassan, if you're still on the call, if you can help me project the, about Pula slide that has, our business in numbers. But basically, the loss ratio, I think, at a portfolio level has been roughly 50%. And so, if the insurers are not making money, that is not a scalable, that is not a sustainable solution either. The benefit to the governments as well as the development agencies and even the farmers is leveling the loss, in years where there is calamity, especially to the small farmers, in years of calamity when their the cost skyrocket. It takes them years, if not, even longer than that, to recuperate from those. And that is the role of insurance. And so in terms of, this is what, thank you, Hassan. So over the last 6 years, our business has helped to bring insurance to over 6.1 million farmers. And these are largely large scale, smallholder farmers, excuse me, because, that is represented in 1.1 billion USD of agricultural investment. So that is the portfolio TSI, let's say. And so if you do the math, it's less than 200 USD per farmer that is going under insurance. That has generated about almost 40 million USD in premium, and about half of that has been paid back to farmers. But even so, these are the largest agricultural payouts in the histories of those countries. And those payouts are scientific, they are objective, and they are timely. And that is made possible because of the reinsurance, that is supporting in every one of our engagements. Great. So if we, I think I'm also just looking at the time, and in the interest of closing, with concrete action items, I think if I may suggest, for those insurers who are interested to join us, we do have a template for the agricultural insurance consortium, and so which has been shared with the IAP team. So please, if we can ask that can be circulated amongst those who are interested. And then if obviously TPL is already represented in the room, and they have been working with us for a year now. And so if there's any questions about the Pula insurer engagement, Iqbal is our main point of contact. And so then I'm sure he would be more than happy to engage with any of his fellow colleagues in this space, to be able to give more sort of clarity, of what this relationship entails, from the insurer perspective. And so with that, I think, Hirji-san, any other closing comments?
No, I just wish you good luck, and I hope this takes off and is successful.
Thank you so much. And we absolutely look forward to working with you. We cannot do this without our partners, in the insurance space. And so we look forward to, working with all of you, to bring agricultural insurance to every Pakistani farmer. Thank you.